And joining me now with more is Joe Brusuelas. He's the chief economist at RSM US. Joe, it's great to have you back in the studio. We had connected last week and you had told us that these GDP numbers were perhaps not looking so hot in the future. What do you make of today's report?
So we have a very noisy report that in many ways is the tale of two reports. The first one is not so good. We had an enormous 4.8% drag on overall growth from trade. That makes sense given the trade shock. We had an enormous 22% increase in equipment. That's a pulling forward of orders to avoid those trade taxes. It resulted in a negative 0.3% decline in the top line. So for the first time in 3 years, GDP has gone negative. Similar to what happened in the first quarter of 2022, we did see a pretty good, what we call core GDP report. That's final sales to private domestic purchasers. Really still spills off the tongue, right? Well, it increased 2.3%. So not so bad. Now, once we dig into the report though, you can see the forward-looking components are very challenging for the economy. So if the takeaway is, we didn't fall into recession in the first quarter, and we didn't, there's a real risk of the economy falling into recession in the second or third quarter of the year. Why is that though? This is really what's important. Overall growth was bolstered by 2.25% due to a $140 billion buildup in inventories, right? So you go up the escalator, then you tend to go down the mine shaft.
And of course, a lot of that, I'm sure, was stocking up ahead of the expected tariff promise that President Trump made along his campaign, and I think shocked many people on April 2nd when those tariffs ended up being much more stringent than originally expected. Joe, to that end, what are some of the forward-looking indicators in this particular GDP report that could suggest that there is some challenge ahead?
First, household consumption slowed to a 1.8% pace. Second, we're not going to repeat that 22% increase in equipment, and that inventory build, that $140 billion, that's going to completely reverse and then some in the second quarter of the year. So what we're going to do is we're going to set up for a slightly better trade number in the current quarter, but those other items that we just listed, they're going to go profoundly negative, and that's when we're going to say, okay, we're in trouble now. And then we'll begin looking much more closely at the labor market, which, of course, this Friday, tomorrow, we're going to get the April jobs report.
What kind of place does this put the Federal Reserve in? And a report today that, by some measures, would show stagflation. Yeah,
so this is really, really difficult times for the Fed. They're going to be shortly in a situation where unemployment's going to be rising, inflation's going to be rising, and you nailed it. We're caught in a stagflationary situation. Under those conditions, the Fed playbook says they should lean towards the portion of their mandate that they're furthest away from. So full employment and price stability. Well, we're at full employment, it's 4.2%. We think it'll be 4.3 and it's going to start going up soon thereafter. But at a core 3.5% PCE, at a top line 3.7%, 2% is the target. That's the one they're furthest away from. Therefore, the Fed will remain on hold indefinitely here. But indefinitely is the wrong word choice, at least through the fall. I don't think the Fed will even consider cutting rates until they see real cracks in the labor market. And that's just the way this is going to roll. I know that's not a very popular message to be delivering in the equity community, equity research community, or other financial markets. But that's simply the Fed's playbook.
Interesting, Joe. So for viewers watching this, how should they be navigating this from a portfolio standpoint? We've already seen a lot of volatility this year. Does this imply we could see more volatility?
I think that you need to go into areas of the economy that are going to be resistant to the cyclical volatility that we're now experiencing. Unfortunately, what you're really seeing is risk aversion out in the market. A little bit of buying on the dip, but not much. And this is what's going to be difficult for the NYSE audience. Right now, the bond market and the currency markets are taking precedence over the equity market. And that volatility is really important. In the immediate aftermath of this report, the US 10-year yield absolutely spiked. It went right past the growth data and went right to that inflation data and that idea of stagflation that you correctly brought up.
So interestingly, Joe, we've seen other central bankers around the world navigating economies in a slightly different scenario, I would say, up until this point. And President Donald Trump has noted this, certainly on Truth Social. We've actually seen other central bankers, particularly in Europe and elsewhere, bringing rates lower. Amid this change and ongoing negotiation with at least 18 key partners that the U.S. has identified in these trade talks, what does this mean for other countries, especially ones where central banks are already cutting rates?
Well, as the U.S. economy moves to isolate itself from the rest of the world, that means their economies are going to slow. They're more likely to experience not inflation, but deflation or disinflation. That puts their central bankers in a position where they can afford to cut. They can take risks. But the stagflation here puts the Fed in the exact opposite corner. That bifurcation, that separation from the cycles, that's not going to be easy to resolve, and it's going to take a while for us to move back to a more pro-cyclical growth stance with the rest of the world. And of course, when you launch a trade war, like we have, and you're really initiating a series of shocks, which we saw in the report, which we've experienced here over the last couple of months, that just is not unwound quickly. So in many ways, it will be the end of the year before we get a real sense of where we're at. And until then, investors are just going to have to ride the volatility to the best they can.
Joe Brusuelas is the chief economist at RSM US, joining us on an important day here with that first look at first quarter GDP. Joe, thank you.
Thank you.